using the cloud, as well as the increased appetite for doing so. To be clear, cloud usage obviously isn't without risk, but nor is the status quo. In addition to reinforcing steps to minimise the risk of cloud usage, the information paper also summarises some of the observed weaknesses that we still think the industry needs to focus on. And it also has that obvious reminder that, as with other shared service arrangements, cloud usage involves a degree of shared responsibility, but boards and management of regulated institutions still remain ultimately accountable for the security of their data, and that obviously can't be outsourced. Now, the dilemma that regulators face in this rapidly changing environment is largely the same as that confronting businesses, trying to anticipate how new technology will change the financial services sector and be sufficiently responsive to keep pace with those changes. So a major challenge that technology poses for regulators like APRA is the growing trend towards outsourcing and partnering. Those concepts are not new, but increasingly they are occurring for business-critical functions, not just for things that are at the periphery of activities. And importantly, many of these new partners and providers of critical functions sit outside regulators' reach. And so the prudential supervisor's ability to, if I put it this way, kick the tyres, will be much harder in future without new tools or methods. And there's probably two potential risks that arise from the broader trend. The first is a possible fragmentation. So as niche specialist providers disaggregate existing business models by performing specific roles and functions more efficiently and effectively than the incumbents can do so in-house. An ecosystem of small providers will challenge management models, and it will challenge regulatory understanding of risks as more data and activity sits outside the increasingly narrow regulated entity. And it does pose something of an interesting thought experiment, which is if in the extreme all of the processes within a bank were totally disaggregated to their specialist parts and then outsourced, which part would we actually call the bank? The second risk is in some sense the opposite. The systemic risk of what might ostensibly appear to be a large and diverse number of regulated entities, all dependent on just a few unregulated providers for critical services, creating a substantial concentration of risk and increasing the threat of contagion in the event of a service failure. Another challenge might come from the so-called tech fins, the large tech companies who move into financial services. Now, I'm sure all of you, as I do, have got some balance in some form of digital wallet somewhere with the large tech companies, and that allows us to transact, albeit within the confines of their website or other offerings. Now, those offerings are not banking, but we are getting close to the point where it may be possible to do banking without being a bank. And at least in concept, it isn't inconceivable that a provider of transaction payment services in Australian dollars could emerge that doesn't have a presence in Australia. It's clearly going to test the regulatory statutes and frameworks because they're built on the concept of a single authorised legal entity with a domestic physical presence undertaking the bulk of critical activities in-house. But if, like Uber, consumers were to flock to some new service, there is a question about whether the law could actually stand in the way. So like everyone in the industry, we recognise change is coming, but sadly our crystal ball is as cloudy as everyone else's. So without clarity as to how the industry will evolve, our goal is to make sure we gather the skills and intelligence needed to be well prepared to respond to whatever technology-driven technology-driven changes lie just over the horizon. So first, as many of you know, we've recognised that applicants for new banking licences mightn't fit the traditional mould and have established a new licensing regime to provide for easier entry, but importantly not lower standards, but easier entry to the banking system for applicants with unconventional or non-traditional business models. The goal of that new restricted ADI regime is to allow applicants to commence limited business while developing their capabilities and resources. But just as importantly, it also allows us to learn and gain comfort with new ways of doing things. And in that way, entry to the system is facilitated without materially lessening the entry standards that are important protections for the Australian community. Along with our colleagues on the Council of Financial Regulators, we're also announcing today, and I think this one is now out on the public domain, we're also announcing today a review of the regulatory framework for purchased payment or stored value facilities. This potentially covers facilities from prepaid cards at one end of the spectrum to services that are bank-like, like a digital wallet. We're only regulating one company in that space at the moment, that's PayPal, but there's a number of applicants in the pipeline with a variety of different business models, and this is an area of considerable innovation worldwide. There's evolving international frameworks, and the Australian framework is actually very cumbersome and unwieldy, so it is timely to review the way we regulate that sort of business here, and I would encourage you all to participate in that consultation. Internally, we're putting increased effort into ensuring APRA has the expertise and the knowledge and the technology itself in place to monitor and interpret the changing nature of the financial system. We've established our own internal FinTech Council to examine developments and trends. Guided by that council, we've stepped up our engagement with a range of players from outside the regulated sphere, like FinTech Australia and the RegTech Association and InsureTech Australia. The purpose of doing all of that is to try and help us keep up to speed with developments and keep abreast of emerging issues that might cause regulatory challenges. We also get some very useful insights from participating in ASIC's Digital Finance Advisory Committee. Now, if you've read APRA's latest corporate plan, and I won't ask for a show of hands who's done that, you will have noticed that one of our strategic priorities over the coming year is to broaden our risk-based supervision. In our 20 years of existence, our regulation has been firmly founded on entities: ADIs, general insurers, life insurers, health insurers, super funds. But the lines defining what is and is not a financial services company are increasingly blurry, and so supervisors in the future are likely to have to focus more on functions rather than entities. And I often call that shifting from supervising entities to supervising ecosystems. Another example in our plan is our data modernisation program, which we commenced last year and has already begun to enhance our capabilities, utilising modern technology and analytics to help us spot trends and emerging prudential threats. And then finally, the pace of technological change also raises questions for us about employee capability, and we're mindful of ensuring that we possess the right mix of skills and experience for us to keep pace as the financial sector evolves. And I suspect, just like you, the entities we regulate, that increasingly may mean we need to do some degree of partnering to find the specialist skills or technical expertise that we need. Let me wrap up. There's no shortage, as I said, of curiosity as to the impact of technology on the future of the financial sector. But prominent organisations that have released reports on the subject, the IMF, the World Economic Forum, the Basel Committee on Banking Supervision, who've devoted a lot of time and attention to the issue, are unfortunately largely unanimous in their conclusion, and that is that it's too hard to predict. Right now, it actually seems inconceivable, I think, to most people that any of Australia's big banks or major insurers might not exist at some point in the future. But the same was no doubt once said of dominant companies like Remington Typewriters or Kodak or Blockbuster Video. Not every financial sector business or business model that is in existence today will navigate their way through the intense period of change that we're experiencing. But as long as they're operating, we have a job to do to insist they're operated in a safe and effective way for the community. What I would say, though, and stress is that by stepping up investment in operational and information security infrastructure, regulated entities are not only fulfilling our prudential expectations, they're actually giving themselves the best chance of not ending up on that list of iconic but now extinct brands. For APRA, technology means change. Changes in the businesses we regulate will necessitate changes to the way we go about our business. The only thing I'm certain of, however, is that we'll need to do things differently in the future. I don't know how, but I'm certainly going to be curious to see how it all plays out. So thank you very much for your attention.
Thank you. Thank you very much, Wayne Byers. Do I have